dollars and cents. You write about their lives. When we talk about money, we tell people where we have been and where we hope to be. My editors understood that they could more easily teach me the difference between an annuity and an average annual return than find another reporter who had the ability to get people to open up about a subject that most of us will barely discuss with our loved ones, never mind the general public. The second takeaway was that much about the handling of money wasn't that hard to understand. Terms and concepts that sounded mysterious were really quite basic. It was easy to learn the difference between a defined benefit and a defined contribution plan, or a load versus a no-load mutual fund, or a growth versus value style of investing. Common sense ruled. If it was complicated and hard to comprehend, chances were you shouldn't invest in it. Financial advisors who were paid by a percentage of fees under management or by the hour really did seem to do a better job than those whose compensation depended on convincing their clients to buy or sell financial products. People who couldn't, for whatever reasons, live below their means generally found themselves in financial trouble sooner or later. Insurance was invented for a reason. Many of us could save ourselves a hell of a lot of trouble by simply picking up a copy of Personal Finance for Dummies like I did when I was first learning and following the advice therein. The third takeaway was this. Just because we could easily learn the basics of savings and investing didn't mean we did so. The ignorance was profound. No amount of lecturing or hectoring or telling people to take financial medicine for their own good actually got people to look into upping their financial literacy. Taking part in a money makeover only seemed to help the people who were already ahead of the curve. When I tracked down a number of our subjects in 2010 and 2011, it seemed as if they had followed our recommendations in a style that could kindly be described as scattershot. For example, it was clear in 1997 to Margaret Wertheimer, the financial planner we assigned to a marketing coordinator and artist whose life had been upended when her husband suffered a disabling brain aneurysm, that the couple needed more comprehensive financial planning and counseling than their broker was performing. The woman interviewed a number of financial planners, but ultimately stayed put because her broker assured us he could help us with this other stuff. In this case, alas, past performance was indicative of future results. Unfortunately, she didn't discover that for more than a decade, when her broker's response to the market crash of 2008 was to suddenly inform her that she was at serious risk of outliving her assets. The fourth takeaway. The column gave readers the illusion of control. I was told many times by editors and advertising executives that Money Makeover was one of the most popular features in the entire newspaper, and I believe it. Money Makeover marked the only time in my entire journalism career when almost everyone I met had read a sample of my work. Anything from a visit to a doctor's office to the occasional invite to a Hollywood dinner party would result in my being regaled with the details from makeovers gone by. What could be the attraction? Sure, there was a financial rubbernecking aspect, but mostly we analyzed someone's portfolio and, in conjunction with a financial planner and other experts as needed, we suggested steps our subject could take to improve both their finances and their lives. Even I thought hearing about the need for mutual funds week in and week out was kind of boring, and I was writing the darn thing. But over time, I grew to understand the column's predictability was an essential part of its appeal. With rare exceptions, there was no problem presented that was insurmountable. You can do it, the column subliminally said, and we believed it. It allowed us to feel more secure about our own ability to manage our funds and future. It was the fifth takeaway that was the most important, and it was the one that took the longest to comprehend. As William Goldman had once discovered about Hollywood, nobody knows anything. The same was true for much of the personal finance and investment culture. Over time, I listened as nationally renowned financial planners assured investors that real estate was a terrible investment or informed them they should eschew gold and silver and other commodities. Others, equally well-intentioned, recommended specific mutual funds because they liked particular managers. Yet another cohort seemed convinced that, yes, maybe the stock market was more than a bit overheated with the dot-com bubble and all, but that shouldn't give anyone pause. History told us everything was going to be fine. Every so often, like when I was profiling post office worker Manny Cervantes and his bank clerk wife Selena,